Hey traders, let's try this again. Okay, please bear with me. First of all, I'm down with the flu. I've been traveling a bit and doing some major energy work, globally speaking, and so that takes a lot of my energy. And usually, when I'm low on energy and we're in the middle of winter, I'm surrounded by people that have the flu. I tend to catch it. Um, so please do bear with me. I've got some medication and stuff. I'm on a little bit drowsy. Now, I've had a number of questions come in over the last few weeks in regards to best time of day to trade, that sort of stuff. In regards to, I think everyone's kind of looking for just certain points where they'd like to trade and forget about the rest. Now, in the past, I have mentioned where familial points would be double, the bottom parts or the top parts of the double bottoms, the double tops. I have spoken about the establishment of trends and then those areas where you can trade. In this video, what I'm going to do is run you through just a set number of, what should I say, probably price points that you can create around which um, you would look for opportunities to trade on. So basically, we're going to start from the daily chart. We're going to work our way back to the 15-minute chart, and then I'm going to run you through things like support and resistance zones, beyond just looking for the tops of wicks or the bottoms of wicks. How to actually select specific price points, and when you see market behavior around those specific price points, then those are possible familial areas where you can look for opportunities. Also, things like candlestick patterns that develop around certain areas, and also especially when you're looking at after the fact reversal. So study these, guys. These are important because when it comes to binary, these are the ones you want to be trading, where you're looking at where the market bounced off. Stare at them, study them, look at what you see, look to see if this candle here is completely engulfing this one and this one. What does that tell you? Where do you think the market's going to head to? That sort of stuff. Extremely important. And some of the, you must have seen diagrams. There's one PDF on my website as well where you can download. Look for those on your charts, and then look to see what the market or how the market behaves around those areas, and that's how you can then establish your own little strategy in those market conditions. The other thing is recognizing the double bottoms, the double tops, or triple bottoms and triple tops, which would also be your M and W, your formations. This here on our screen right now with the Euro JPY pair, this is a classic example of a multi-session W. I'm going to run you through what to kind of expect when you're seeing something like this. When I'm seeing something like this, especially after this point here, the market is pushing up, well, you know that there's going to be a significant climb simply because this is a multi-session double bottom, right? Or a multi-session W. Now, I'm going to briefly run you through Fibonacci as well here because Fibonacci can actually help you to determine specific areas on your charts to see, for example, when you see this move happen here, you'd be able to, even up to here somewhere, you'd be able to use Fibonacci to predict where the market's going to retrace off of. So in this case, be able to say that there's a very high chance, a high probability that the market is going to retrace back to around this point here. And when we draw in the Fibonacci's, you'll see a clearer picture as to how and why. We're also going to have a little chat about the market maker, market dealer behavior and how that fits into the whole scope of things. I'm also going to introduce you to the Cordis theory, which is a book that I've got on the website. So if you go onto the website on the downloads page, scroll down about halfway through and click and download the Cordis theory, have a read of it. It's a fantastic book. The theory has been around for a long, well, the information in regards to the theory has been around for a very long time, but excuse me, the book's quite recent. only going back a few years, I believe. The beautiful thing about this is that over the years, this is stuff that we've looked at. When you're assessing whole numbers, uh, I actually looked at this playing out during the Brexit results release, when the market tanked a couple of thousand pips for different pairs, and the Cordis theory was upheld, beautifully upheld, and that's something that I wasn't familiar with, where the market upholds something like that, especially as a result of a fundamental movement in the market, not so much as a technical movement in the market. But excuse me, it did uphold. So I'd like for you to have a read of that. And then last thing is, when you're applying harmonics. So let me run through the various points, aspects that you're going to be looking at with your chart. So the first thing you'd want to do, let me get rid of these lines. One of the first things that you do is when you jump onto your charts, well, let's start off with this, mind you. I've got too many currency pairs open right here, right here. Usually it's because, if I'm analyzing, I'll look at different currency pairs, but there's only 6 of them that I work with. I want you guys to select maybe 3 or 4 maximum currency pairs that you're comfortable with and you're ready to work with. So these 4 currency pairs are going to be like your friends, right? Your best friends, in actual fact. And you're going to spend the next 4 weeks, say for instance the rest of July, to really get to know it really well. And within your books, for those of you that are writing your trades down, what I'd like for you to do is also, possibly from the back, start writing down certain behaviors that you see with different currency pairs. So the 4 that you do choose, and as you start noticing and writing down the different personality traits that those currency pairs have, you'll start to become more familiar with it. Now, with binary options, the key is to trade that which is familiar. All right, I've said this so many times before. Binary options and forex, they do differ quite a lot, but the same technical analysis can be applied to both of them. Yes, forex is easier simply because if you've predicted your direction accurately, then what you're going to find is that eventually, even if the market retraces back on you, or if the market consolidates for a brief period, that eventually you will be in the money, or you will be in profit, and so you can walk away with a decent amount of money. With binary, the restriction of time actually does cause a lot of havoc for a lot of people, and this is where we need to be extra careful. Having said that, because I've made this statement in past videos, there is a great number of people that have simply done away with binary because they find it too difficult, and they've jumped onto forex. Now, here's the thing that you've got to look at. Whenever you trade, doesn't matter what you do, stocks, forex, binary, futures, whatever it is, you've got to ensure that you're always diversified. Okay? Excuse me. So when it comes to forex, you got to understand that to make decent money, like a few $1,000s a day, you're literally looking at having a huge outlay. So, for example, if you wanted to make, say, roughly about $1,000 a day trading either one of them, in order to make about 1,000 in forex trading just one lot, you'd require about a movement of say 100 pips. If you wanted to lessen that and say instead of just one lot, you trade 5 lots, well, in order to make $1,000, you probably need to you need 50 pips to make that. However, the margin requirement for something like 5 lots may be something like 5,000 or probably about 8,500 or so. Right? If you were to say trade 10 lots and just do a movement of about 10 pips, well, that will get you $1,000 in forex. However, depending on currency pair, your margin requirement might be something like 9,000 to about 13,000. Right? On top of that, excuse me, the minimum requirement that your broker would have in terms of reserves. Wow. So the minimum requirement your broker might have in terms of reserves might be more than about 40% or so. So you'd probably need about 15,000, 20,000 or more to safely and easily make that kind of money. Whereas with binary, if you're a decent trader and you're able to do 2 or 3 really good trades a day, even with a decent account, say with a few $1,000s in there, you could take a few $500 trades or four $250 trades or so, or pounds or whatever it is, and still make your $1,000 returns. The key thing, once again, when you're trading binary, is trade that which is familiar. Okay, so here's what we do. So first thing I do is once you've launched your MT4 or whatever charting software that you're using, what I'd like you to do is have a good look to see what the market is actually presently doing now. Look to see where you are in terms of transition. So right now we are heading into possibly London Open, and already the market's tanking a little bit. Usually at this transition moment here, we don't trade, simply because there might be false moves that are happening. Okay. Now, one of the key things to look at is not only what this session has done previously, but also what the previous sessions have done. Now, I'd have a quick look to see if I'm seeing anything that's familiar here. Straight off the bat, I noticed that yesterday, during the Asian and London sessions, we saw a double bottom appear. This is a multi-session double bottom. So this tells me a few things. One is that this market is going to head up. There's going to be a retracement that happens, and this retracement will possibly be at least about 50% of this. This is just an expectation that I have, and then beyond that, the market is going to climb again. Whether it's going to continue going up this way or just be slight climbs, we don't know yet, but we can use this information of what happened here to determine what the market's going to do somewhere around here. And when you start seeing that familial behavior, well, that's another opportunity for you to trade, right? So here's just a quick look. I've got that Stratman mini charts on the right here, sorry. And what I would do here is just quickly have a look to see what the 4-hour chart is showing me and what the hourly chart is showing me, okay? Is there something familiar that I haven't noticed? Here, this to me starts to look like possibly the formation of another double bottom pattern. We'll see. This could also be a stop hunt at this stage, stop hunt low. We don't know. But what I would then quickly do is jump onto the daily time frame and start doing my support and resistance zones. Okay, again, those areas, once you see something that's familiar, especially when it comes to support and resistance zones, what you'll find is that if price action is somewhere around an area that you've identified where a possible reversal may happen, well, that's familiar territory, right? So you will then start looking for other things like candlestick patterns, whether it's going to have a Fibonacci retracement point, patterns in terms of harmonics that is forming. You'd also look to see if there is any sort of market maker, market dealer behavior. So things like a stop hunt that's happening, using wicks to the high or the low, that sort of stuff. Okay, so first thing is that we'll have a look to see if there is any clear identified zones in terms of support and resistance. Excuse me for a sec. Okay, so we'll look to see if there is any particular zones around there. One of the key things that I'd like you to start looking for is using your crosshairs, is look to see what the actual price point is at the high and the low of your wicks. So in this case, when I've got my crosshairs right at the bottom here, what I'm seeing is that is somewhere close to the 109.00 mark. It is 140 over, but it's relatively close. What that says to me is that it's very close to a whole number. Okay, so between 109 and 1010, there's 100 pips. Between 1010 and 110 and 120, there's 1,000 pips. And what we'd find is it's around those whole numbers where you'll see wicks actually forming. So the body will close back into or within those whole numbers. Those, again, are familial points. Once you read the Cordis theory, you're going to become more familiar with what I'm talking about. So certainly please download that. Have a read of that off the side. Now, what I want you to start doing is start drawing in these lines. Okay, so if you see, say for instance here, this is, I believe, I don't know when that happened, probably a couple of days ago or yesterday, might have been. I haven't traded all week. So when I put my crosshairs there, look at that. It's at a whole number. It's 122, 014, very close to the whole number. So the expectation is that when the market pushed above the 122 mark, there was an opportunity for me to trade a reversal beyond the aspects of the EMA 50 being there. So again, this becomes another familial point. This is where I might consider saying, okay, if price does break past that, maybe I could do a trade there. Even down here, when we're looking at it, the whole number, which would be from 110 to 120 here, I'd look to see when this price started falling from 122 all the way down here, I'd probably would have said, okay, well, let me see. Now, what I could do is quickly, now this is, remember, off the daily chart, so I'd grab my horizontal line, just drop it anywhere, double click on it, go into properties, parameters, and what I do here is draw in my 110.00, 110.00. Okay, so that moves this line there for me. Now, what I could have done is, what is this? Get rid of that. What I could have done there, one second. Let's just say it's at the 110 mark. What I could have done there is when price broke below the 110 mark, I could have considered doing a reversal right there. The reason for that is chances are that the market, this was a 1,000 pip drop, chances are the market will bounce back over there. Okay, you're not going to always see this, especially when the results actually came through, because simply that movement was something closer to about, for Euro JPY, I believe that 1,500 pips as opposed to just a 1,000 pip move. But in smaller movements, something, especially when it's technical analysis as opposed to something that's fundamental, what you're going to find is this theory will be upheld. Okay. The other things you want to look at here is over the course of the last number of months, Euro JPY has been on a downtrend. And look to see if, for example, here this aqua line is the EMA 50, this is the EMA 200. Look to see how prices behaved around it. So if you notice, every time price has hit or crossed the EMA 50, it's always come back down again. So Forex traders, what you might consider doing is to say, okay, every time there's a cross, you might take an entry south. Now, see, look at just that one candle, one daily candle there is 49 pips. 3 days later, we're talking about 445 pips. Maybe there's an opportunity there, or something close to. So that's something. I mean, if you certainly have the heart for it, you can take your longer term trades. This probably would have been a couple of weeks. We're looking at about 800 pips. So look for those opportunities, and that's going to give you something that's familiar. Okay, that's where we're going to get to. Now, what you want to do is work your way down, jump onto the 4-hour chart. If you have drawn lines into your daily charts and you've priced them, numbered them, jump onto your 4-hour chart and then have a look to see what the market actually did around those points. In this case, we've got a very comfortable gap between this line and the body of this candle, so something to look at, certainly. The next steps beyond this is now, depending on what time frame you're trading, work your way down. Go from the hourly chart, have a look to see what the market's been doing there, and then jump onto, say, your 15-minute charts. Okay, this is where I normally trade. So here's where I would start doing a number of things. Once I make it back to this page here, one of the first things that I will start to do is grab my horizontal line and draw in where the high and the low of the previous day was. Okay, so in this case, the previous high would have been here. However, I'm going to draw it in here because I want to apply it to the New York session. I'm going to, in this case, you probably don't need to do this because the market's going to move in a particular way. But however, I'm going to do the low of the New York session. You can actually put in then the previous low of the low of the previous day. And then also what I like to do is look at where the day opened. So in this case, first candle of the Asian session, and I drop a line in there as well. What you're going to find is that a lot of the times these lines are respected. Not always, but a lot of the times. And so what I do is, the purpose of drawing these lines in is so that I'm creating those little territories where something is familiar for me. Okay, so when price does come somewhere around here, it's something that I know that I'm looking for an opportunity to trade that. Okay, in these cases, what I would find is that usually the first hit, you'll be in the money. If say for instance this breaks right through, this would have been the first hit. Reversal, you end up in the wick. But in this case, you probably still want to be wary. The market's broken through. What I like about this sort of trade here is when the market does break through the next candle, oftentimes, if this was to come back up, I would have traded a put if this candle here, or the wick here, would have hit this line. Okay, a lot of the times I am in the money with that sort of trade. So certainly demo that. That works well. After this, what I'd start to do is pay attention to where my EMA 50 and where my EMA 200 lines are, and then look to see what price has actually been doing around those points. Okay, so that creates another area of where something is familiar. Excuse me. Now, the next thing is when you're looking at your charts, you're looking for the double bottoms, double tops, triple bottoms, and triple tops. In this case, we do have a beautiful multi-session double bottom. Now, here's what I usually do. If I see a multi-session one, that means there's a significant move that is coming. All right, especially when you're somewhere here and the market's pushing back up again, creating higher lows. So in this case, look at this. This is a higher low than this. This is a higher low than this, and then the market drastically pushes back up again. When you see that sort of move, especially when it's happening at the transition of a session, well, chances are this whole thing, this is going to be a multi-session double bottom in this case. That's when you start to recognize that there's the potential move is possibly going to be a decent one. If not entirely all the way up there, somewhere close to it. Okay, so that's part of your prediction, something that's familiar. So what I would be doing in this whole entire area is looking for opportunities to trade a call. Right? Part of my EMA 6 strategy here would be, and this is different from the EMA 6 to 2-minute one, is when I'm looking to see where the market opens, pulls back down somewhere below my EMA 6 line for me to then take a call trade going with the trend, because this would be a recognition of the trend. Now, after the transition of a session, New York has opened, what I'm looking for is a false move, especially again if there's going to be a decent move. I'm looking for a false move. In this case, the false move is the whole consolidation that's happening here. We're seeing a couple of hits to the low, which is the stop hunts. All right. If you see a few of them, and then you see a move like this, one big candle getting the hell out of here, this space here, well, that to me now says, okay, the trend has officially begun. Especially, I mean, this is a fair distance into the New York session, so that's again something now that is familiar for me to trade. All right, so how do I look at all of this? And someone might be asking me, well, Shiv, okay, first of all, this is a trend coming down. I haven't looked at what's happened previously, so I don't know what would have triggered this off. But let's say, for instance, this is happening here. What would I trade off of here? Would I be considering this to be the bottom instead of this, because this wouldn't have formed yet? To be honest with you, I wouldn't know. You wouldn't know either. Yes, we can say these are see this candle here is completely engulfed this candle here, and even this one here. Um, this one did break the low of this, but you can still call this a completely engulfed candle. And chances are you might say, well, this is going to head back up here again. Say, for instance, this candle hasn't formed. How do you know that this is going to be a red one and not a green one? You don't. Okay, simple answer, you don't. What we're doing is we're looking for this whole entire formation to complete and start heading up this way, right? So here's what I would be considering is, I'm going to use my fibs. Let's go at the top of this, draw my fib in to the bottom of this candle here. And what I will predict is this, that this formation has happened. I'm going to now wait. Now, in this candle here, this movement here, you could have potentially considered trading a reversal off this 38.2 line after that. And you'd say, okay, this would be my hit. Once price has gone above that, you've got a little bit of a buffer, and you can possibly trade the reversal. There's an opportunity right there. Now, again, I probably do that just once. All right? Market's moving up. Now, at these points here, I don't really like trading anything below the 50% mark. So when the market's pushing up, what I'm considering is the potentiality of a reversal happening at least at the 50% mark, or definitely at the 61.8. Right? So now something is starting to become familiar to me. And here's where I would start looking for candlestick patterns. If say for instance I've got support resistance lines, zones on higher time frames there, I'll be looking for whole numbers. I'll grab my crosshairs and say, okay, are there whole numbers present? In this case, you'd say, okay, you've got 112 somewhere close by. Where is 112? All right, so there we go. 1112 is very close by there. Yeah, I probably put a line in there and say there's the potential for me to trade that. Okay, so that's where you're looking for your opportunities, and that might explain why this price actually didn't go above to hit the 61.8 line, simply because by that point in time it would have been well and truly above the 1112 mark. So again, remember whole numbers. When price breaks those whole numbers is when you want to be trading it depends again your strategies, but that's where you start to apply those strategies. Excuse me for a second. All right, so that's one thing. The next thing is the market pushes back down again. Now, when this is happening, at this stage, this is the third wave of my double bottom. At this stage, I'm not fully certain that this is going to happen, right? So we wait for market to come down, and when market does penetrate this area here, which is below this point here, the low of the Asian session, and then the market starts to consolidate. When market does consolidate, after this here, especially when here's the other thing, you possibly would have considered a trade off of this candle here, because you truly don't know when the market's going to decide to continue pushing up. Now, I'd be a little bit wary simply because we are very close to transition into New York, right? So New York, I think, God, my mind's not working. I think New York kicks in for me at about 10 p.m. Sydney time. 8:30 to about 10 p.m. I'd be a little bit wary of triggering off any trades, simply because, especially if there's a multi-session double bottom or multi-session double top, simply because there's a very high chance market may consolidate. There's got to be some false moves happening, and when you're looking at this whole entire move, I'll do it from here all the way up here, which is 136 pips, you're pretty certain that, well, first of all, you're certain that a big move is coming, especially when the market makers go into the trouble of creating this whole entire structure for you. But when the market is going to move a fair distance, especially for the euro pairs, then chances are they're going to want to ensure that a number of stop hunts have been had, simply because they don't want to carry you with them. And if they do, they lose money. All right. If you were a major dealer, wouldn't you do the same thing? So expect what may come. All right. So consolidation here. You don't really want to trade it. What you do want to trade is when the market is in clear straits, when it is trending. So again, when the market's in consolidation here, people will be like, "Well, Shiva, how would you trade that?" I'd be like, "I don't have a freaking clue," because when it comes to binary, you wouldn't know what the market's going to do. You don't know how long the consolidation period is going to be there for. You could draw lines in here and you say, okay, I'm going to trade a reversal off of this. But once again, when you're in stop hunt territory somewhere around here, you don't know how big the stop hunts are going to be. Why? Well, here's the thing. You don't know how much money is stuck where, right? The market dealers, the actual brokers, they get to see it because it's on their screen. But us as retail traders, we don't know how much money is sitting where, all right? So we don't know how far these guys are going to move the market to pick up those orders. If you don't know something and it's not familiar to you, you simply don't trade it. All right. And here's the key aspect of becoming a trader as opposed to a gambler. You want to trade certainty. All right. Market thrives on certainty. Successful traders trade that which is certain. All right. So I've changed that certain word and I'm saying trade that which is familiar. All right. The other things that you can rely on is this, write this down somewhere, is where when you're looking at a multi-session double top or double bottom, what you are almost guaranteed of is that when the market does eventually move, it's going to move quite significantly, and then also there's going to be a retracement that happens. So what do I mean by that? The market's going to pull back at least 50% of that initial move. All right, and I'm going to prove to you that this pullback here is at least 50%. That's what I'm looking for. Sometimes it might come up to the 38.2 line, might be at the 61.8 line, but I'm reasonably expecting this to be at least a 50% retracement. So here's what we do. Let me get rid of get rid of that Fibonacci lines. So you're looking for the market to retrace at least twice, all right? And it's not going to happen together. So what you might find is that the market climbs and then it pulls back at least once at up to 50%, then it's going to climb again, and chances are it will retrace back again. The second one, we've got no idea how far it's going to retrace to, all right? One sec, where are we? Okay, we are. All right, so let me grab my fib. Now I'm going to do the bottom of this and the high of the New York. All right, look to see where the market retraced to. Look at that. That's at the 50% mark. So when this is in play, what I'm expecting is that when the market has completed doing their thing, and this is going to most likely be in the next session, and this is why, you know, when I said you turn on your charts and then you have a good look to see what the market has done, that's going to give you some degree of indication about where the market is going to head to. And so what we're doing here is we're saying you could have predicted this at any point in time here, even here. Remember when we were talking about this candle here? If you can predict beforehand that the market's going to retrace, chances are you're not going to be looking at doing reversal trades unless the market gets to a specific point. All right, especially for euro and pound pairs, what you're looking to see is that a euro pair, if it's moved, Anything more than 70 pips, you're expecting a 50% retracement. Okay, pound pairs, anything over 100 pips, and you're expecting a 50% retracement. Again, trade that which is familiar. So in this case, I'm expecting that at some point, and this could have consolidated for a while, at some point, the market would have come back and retraced down here. With the benefit of hindsight, where you could consider this to have been predictable is when you're looking at this. This is one hit to the high, two hits to the high. You get a number of wicks there, and this is the third hit to the high. Also, this is the EMA 200, bounced off there, market came down. You can almost instantly expect that the retracement has begun. All right, this sort of stuff is what I want you to demo with, because the more you demo, the more you become familiar with it. And I guarantee you, if you do 100 demos of something that's familiar and you find that you're hitting about 80 of them, 85, 90 of them, your confidence is going to skyrocket. You won't have any emotions, especially with any losses you have, because you know you've just done 100 bloody trades and you won 90 of them. Right? And each time that you do those trades, it's make sure you follow the same criteria. A lot of people, they've done 10 trades, they've nailed the 10 trades, something happens to them, they become overly cocky, and the next thing you know, that they start losing trades. And it's simply because they've started to jump the gun a little bit. They've started to miss out on specifics of their criteria. Please don't do that. Follow your procedure, follow your steps. So again, if I'm expecting a retracement, this is what's going to happen. Here's what you see. Multi-session, double top or double bottom. You're going to see at least a 50% retracement the first time, and then you're also going to see another pullback happen. So this market won't just automatically come all the way down here. All right, you'll see this, you'll see a pullback and then a climb, a pullback, a climb, and then you probably see a double top, triple top, or something along those lines, and then the whole process is repeated. Remember in past videos we talked about sandpit, right? If I could help you identify that with seasonal price pattern, monthly targets, quarterly targets, biannual targets or annual targets that your dealers would generally speaking have, most of them will possibly be whole numbers that they're given, right? When you understand that within their sandpit they've actually got a top and they've got a bottom, then this whole idea of waves and patterns developing comes into play. And when you're expecting that waves will happen, it's like surfers. You know, when they see a wave, they can kind of tell which one's going to be a big wave, which one's just going to be a tiny one, that sort of stuff. And what they do is they jump onto the top of the big waves and ride the wave. It's exactly what you want to do here is when you see that there's going to be a top and a bottom and then the market's going to move in waves between excuse me, between those 2 points, what you're looking for is that familiar ground when the market does bounce back. So again, in this case here, you might not be aware of the fact that market's going to go all the way up here, but what you could have done is select possibly after this fact, select this to be your bottom and maybe go to the top of this here, right? And what you would have expected is that even here, if there is going to be a quick correction, which would be a false move that the market will do, chances are it will come back towards one of these lines. So in this case, the market did a correction on the 61.8 line. Excuse me. So that's where you'd probably look for opportunities where once the market's moving away from that, the trend has begun. You're jumping onto the actual wave. And you can do your longer term trades. You can do, what's that platform? Nadex. Nadex or IG markets. All right, so look for those sorts of opportunities. Now, I'm starting to get a bit of a headache, guys, so I'm going to turn off the video there. I hope that's helped you guys a little bit. I'm going to create, hopefully sometime today, if I don't feel too sick, is a quick video on Fibonacci retracement. I know someone did ask me for it, so I'll create do one on that, and I'll certainly do one on Brexit. and there's a few other things that are coming along as well, which I'll create and put up shortly. If you have any questions in regards to this, please do let me know. So, in summary, it's utilize what I've said here to establish for yourself specific areas within the charts that are familiar to you. And it's those familiar areas where you want to actually look for opportunities. So, wicks, candlestick patterns, that sort of stuff, and then you'd naturally be able to trade that. Okay, hopefully that's answered your question. The last thing I think it's a common question I get is, Shiva, when is a good time to trade? There isn't a specific good time to trade. One, you would be limited by the opportunities that your broker provides to you. So, for example, certain brokers only open at a particular time of day, and then they'd go through their own behavioral patterns. So they'll offer certain expiries only, that sort of stuff. So you'd have to work around that. You might get opportunities from the market to trade, but your broker might not offer that. So it's a complete waste of time for me to say trade only around this time. Two, markets are going to behave exactly the same way all of the time. It probably will in terms of market movement and sort of stuff, but for you to be able to then execute a specific entry, it's just not possible, right? So you're going to have to look for these areas that are familiar to you at whatever time. And when you see something that's familiar, that's when you start looking for opportunities and say, okay, yep, this is something I know how to trade, right? And that's where you take your trades off. All right, guys, I hope that's helped. Time for a Panadol. All right, all the best.